Welcome to the Sharon Partners quarterly market update for the first quarter in 2025. I am Kim, and as always, I'm joined by Dr. Steve Garth. Steve, thanks for joining us.
Yeah, thank you, Kim.
What a quarter it has been. We usually follow a pretty standard format with these, but Steve, I think we're going straight over to the US first.
We are going to go straight to the US, and even though we're talking about the end of the quarter here, as everyone's aware, Kim and I are recording this on a Thursday, the day after Donald Trump said, actually, these tariffs, I'm going to wait 90 days before I implement them. Markets have been down a further 10% from the figures I show you, but last night they're up by 10%. So the figures that you see here are going to be about right. More importantly, though, what's been happening since the start of the year is really just been the forerunner to what we've seen in the last few days. So, Kim, starting in the US, normally I would show a chart of the S&P 500, the big US index, but it's actually made up of two separate exchanges. One's called the New York Stock Exchange, it's where the older industrial companies are listed, and the other one is the NASDAQ, which people now hear about all the time because it's where Apple, Google, and Microsoft all reside. And you can see in the chart here that last year, not a bad return from the New York Stock Exchange, about 15% or so, and they're even a little bit positive in the quarter. But look at the NASDAQ, up an extraordinary 30% last year. So in some ways, not a surprise that they've been down by 10% at the end of the quarter. Now, as I mentioned before, they've fallen a further 10% up until last night, and they're up about 7 or 8% today. So they're a little bit more negative than those figures. But you can see that what's really playing there is the tariffs, or the threat of tariffs. So they got announced in April, but everyone knew they were coming, and that's what's really unsettled the market.
And Steve, why does it seem to be those tech stocks that are impacted?
That's a great question, Kim. It's really got to do with the tariffs. First of all, the threat of tariffs, and if they're actually implemented as they were originally stated, they're quite inflationary. They're going to cause inflation for the US. And tech stocks do not like inflation. They don't like higher interest rates. They're more sensitive to it than other stocks in the market. There is another reason, though. One of the biggest stocks on the NASDAQ is a company called NVIDIA, which I don't think anyone had heard of 2 years ago, but they make chips for the AI industry. And you can see in the chart here, wow, they returned 179% last year. Incredible. Guess what? They're down 20% now, partly on that uncertainty. But the other reason is in February, just as they hit their peak, the Chinese launched a competitor AI chip called DeepSeek. And DeepSeek was cheaper, faster, more efficient than NVIDIA's chips. And the market did think, oh, maybe we've been a little bit too enthusiastic about NVIDIA and how it's dominating the AI space. With competitors out there, maybe we've overvalued it. So there's a bit of a revaluation going on in the tech sector as well.
And so, Steve, while the Australian news has been dominated by Donald Trump and the US market impact, that the main impact has been overseas. What can you tell us then about the impact to the Australian investment markets?
Yeah, very interesting, Kim, because believe it or not, Australia's not really directly impacted by tariffs. Some industries are, beef, obviously, but in general, tariffs don't really affect our stock market. So why are we down? It's got to do the tariffs. They're also going to be bad for the global economy, and Australia's economy is already pretty weak. In fact, our GDP growth is sort of traveling at the slowest it's been for a few decades. So our market is really down more for economic reasons and specifically got to do with the tariffs. But the tariffs are causing the uncertainty, dragging the economy down.
And Steve, we always need to have a good chat about interest rates too. What can you, a bit of an update on that?
Yeah, so in relation to, we just talked about the economy slowing, what should central banks do when economies slow? They cut interest rates. And up until more last week, people were predicting that there'd be quite a few interest rate cuts coming this year from the RBA. The trouble is with the turmoil that the tariffs, are they on, are they off, this incredible volatility we've seen in the last few days, it's put central banks in a bit of a rock and a hard place. Economies are slowing, so I want to cut rates, but tariffs are inflationary, and inflation means I need to raise rates to cool inflation. Now, no one's thinking that central banks are going to raise rates, but it might mean that central banks are going to sit and be on hold for a little while longer. So I'm not much of a forecaster, Kim, but if I had to, go one way or the other now, I think that the RBA will cut rates in May, but it's also quite possible that they'll just sit there waiting for a lot of this volatility to work itself out.
And Steve, one of the words I love that you used during that explanation was uncertainty, because this is a really great example of that uncertainty playing out in markets, investors getting worried, investors having really short-term reactions. Of course, we always talk about the importance, and this is a great example of how important it is to maintain a disciplined approach to investing and maintaining the right asset allocation, because we don't know what's going to happen next in the world, and all of these things do have an impact to what people think might happen next. But a great example again on sticking with diversification and things that we know work well over time.
And we've been in situations like this really many times, Kim, and always the best solution has been to stay disciplined, stay in your seat. If you can, turn off the media because it's designed to scare you. $3 trillion written off the Australian
Media
superannuation
loves a
scheme.
good headline.
No one's lost $3 trillion. Just the markets have gone down and they'll come back up again. So by all means, grab the popcorn and sit and watch what's going on. But whatever you do, don't react to it. Don't change your portfolio on it. It's uncomfortable, but it doesn't mean anything's wrong with what's going on.
And that's another good point. It is uncomfortable when you watch things like that happen. But the other really important thing to remember is to maintain a bit of a long-term view. It's really easy to just look at really short time periods and worry about it. And human nature, unfortunately, is to compare your portfolio to the highest point it's ever been. But if we can expand it out a little bit longer, often it can give the comfort that these are short-term wobbles that are necessary and normal in a normal market cycle.
It really is uncomfortable, but it is normal.
Yeah. Well, Steve, thank you so much for that explanation in what's going on. It has been such a dramatic time. We look forward to you joining us again in the next quarter.
Terrific. Thank you, Kim.